10 stocks I am relentlessly buying in the market right now. That's what we're going to get into in this video, guys. I'm going to share with you 10 stocks that I'm personally buying pretty darn heavily right now, and why I'm buying these certain stocks. And this year for me, if you didn't know, is an accumulation year. So this is a year where I just focus on adding ownership of different companies out there, and that's what I'm focused on. Not real estate this year, not cars, nothing like that. This year for me is all about adding things to my garage, such as guys on the wall, lights, and then just adding ownership to companies and having ridiculous hair, which is pretty normal for me. So anyways, hope you guys enjoy this video. As always, I appreciate you joining me. Also, if you want to check out FTX US, check out the first link in the description down there. It's the easiest way to buy crypto. It's also 24/7 customer support, 85% lower fees than competitors. Use referral code HOLYSMOKES and get free crypto when you start trading through FTX US. First link in the description. Alrighty, guys. So, this was as of yesterday. Obviously, the market's been just kind of devastated recently. At the peak low yesterday, the Russell was down over 25%. NASDAQ was down 24%, which is pretty darn vicious when you're going through that sort of market. We're off to the worst start in decades when it comes to the global indexes. The chart's self-explanatory. So it's been a rough market in these sorts of markets. Obviously, I'm much more incentivized to just stay focused on buying stocks and increasing ownership in companies that I really love over the next 5-10 years. Okay. So first one of the bunch is Oatley. OTLY. If you don't know this company, basically they're a huge player in oat milk, which is replacing dairy milk and will continue to over the coming years. So at some point in this decade we're in right now, at some point cow milk will, and basically oat milk and let's just call it alternative milks. Basically those will one's on the downtrend, that's cow milk, and the other, almond milk, oat milk, all these different alternatives, they're on the uptrend. And at some point in this decade, those will cross, and basically milk alternatives will become bigger than traditional cow milk. Let's call it that, okay? This is a trend that's going on. And we're not going backwards on this. We're just going to move forward. Oatley's at about a $2 billion market cap. They're the number one player in this market by a mile when it comes to branding, distribution. They've got facilities they're getting up and running. It's amazing. And the brand they have in the space, they're the creme de la creme, and then there's everybody else in this space. Price to sales ratio of 3 right now. Forward price to sales ratio in the 2s when it comes to this company. Very strong growth company. Stock price has been devastated, obviously. The stock's down 58% this year. It's been obliterated. The stock hasn't been able to get a shareholder base because it went public last year at a time period when retail was already starting to leave the market, and a stock like this, Wall Street hasn't even been able to consider it yet, right? Because all the devastation out there in big tech, never mind like how they're going to get down to an Oatley. So it's just kind of been in no man's land recently. Price to book of about 1.5 on this company as of right now. What you're looking at right there in front of you is a food store in Sweden. This is the way I see it going in the United States over the long term. I think you're going to walk in and see just massive amounts of Oatley products. And it's not just milk. They also make yogurt products. They also are huge in the creamer space. And, if you drink coffee or anything like that, they're huge. Oat milk is massive. Like you go to Starbucks, and I can only imagine how much an average Starbucks goes through as far as oat milk now. A lot of people are already preferring basically Oatley or some sort of oat alternative for their creamer rather than traditional creamer. So yogurt, ice cream products, you're already starting to, like if you go to your local Target, and if you live in the United States of America and you're watching this, go to your local Target, and what you'll find is they're going to usually have several different SKUs of Oatley in the Target stores, and they also have different ice cream products that are made with Oatley as well in your local Target or something like that. So definitely check that out. And this is a trend that's just going on. In Oatley, they're now in the United States. They just entered the United States a couple of years ago. They're now in China as well, massive facility in China. And on top of that, they're in Europe. Okay, so you're talking about exposure to Europe, China, which China could be a bigger market than Europe and USA combined, actually, for Oatley long term. And so this one is just in my opinion, got just ridiculous upside over the coming years. And I'm pretty confident it's going to be a massive moneymaker for me. Number 2 stock up here is Amazon. So Amazon, I literally just started buying this stock. It's gotten hammered recently. First off, Amazon stock hasn't gone anywhere in almost 2 years now. Almost 2 years, Amazon stock hasn't gone anywhere. But recently, it got absolutely devastated. And so I just started buying this one maybe a week ago or so, and just slowly starting to add shares. I'm just going to continue to add shares. As long as the stock's in this sort of price range, I'm just going to continue to add shares. I mean, when you buy Amazon, you're getting not just Amazon, the traditional e-commerce business, you're getting AWS, right? Amazon Web Services, you're getting Twitch, you're getting Whole Foods, okay? You're getting Zappos, you're getting so many different other businesses. And when you think about just Amazon, the e-commerce business, just the e-commerce business, and you think about all the distribution centers this company has, you think about the fleet of vehicles, the planes they own now, and you think about that, like to me, the e-commerce business itself is worth $1 trillion. AWS in itself is worth $1 trillion, okay? And then you add all the other businesses on top of that, like Twitch and Whole Foods and all those other businesses. It's like, what are all those worth? So to me, to buy this company at $1.2 trillion market cap or so is like stealing money, essentially, in my personal opinion, okay, based upon all the valuations I run. And if you ask anybody that really is educated on valuations, they'll tell you AWS alone is worth about $1 trillion, okay? And so, and most people, once again, when they think about Amazon stock, they think about the e-commerce side. They don't even think about AWS. That's just like the craziest part, okay? And so, yeah, I mean, this is just a beast of a company, right? Now, in terms of numbers, Rivian's hurting their EPS this year, and the reason being is essentially, if you haven't been tracking Rivian stock, it's gone down massively. And so it makes Amazon's EPS look way worse since it's a major investment for them, and they have to, basically, they have to report like how much Rivian's stock price went down, and so it hurts Amazon's EPS. It's basically what you have to do when you do GAAP earnings. Now, in my opinion, it's completely ridiculous. They changed the accounting standards several years ago, and I don't think it's right. I think it's silly. It's not Amazon that did this. This was just how all companies have to report moving forward, and it's ridiculous because whether Rivian stock goes up or down, it shouldn't really change Amazon's EPS, right? It's not like they're selling that, but that's the way you have to report nowadays. And that's why Berkshire Hathaway's earnings are all over the place, because if Coca-Cola and Apple stock price goes down a ton, and American Express and a few others, Berkshire Hathaway's EPS all of a sudden magically looks all low. It's a really silly thing. We're getting into the weeds there. But anyways, that's why the number's there. It's not because Amazon's business all of a sudden got devastated or something like that, okay? Things are supposed to get back on the up and up next year as far as EPS goes. Revenue growth is expected to be pretty lame for Amazon this year, about 13%. Once again, for Amazon, that's pretty lame revenue growth, but they had a crazy year last year, so it's kind of the coming down of that. You got these tough year-over-year comps. 17% revenue growth expected in 2023, so a reacceleration back to more normalish growth. Amazon's a company that I usually expect to grow 15 to 20% a year. So anything less than 15% is out of the norm. And this company's on its way to becoming the first $1 trillion revenue company out there. And I think they're going to do it. So yeah, Amazon. I've never been able to buy the stock, but recently it has emerged as, in my personal opinion, a very good deal in the market, okay? Next one up here, number 3 of these stocks, the 10 is Meta, another big tech company. And big tech for a while was not trading cheap, but recently a lot of these stocks have gotten very cheap. Meta is one of those companies that's gotten very cheap. The year to date, the stock is down 37%. And some shares I was buying about a week ago or so were even much lower. I think it was under 200. Market cap on this one, 575 mil. Obviously, when you buy Meta, you get the Facebook platform and everything that comes with the Facebook platform, right? You get Instagram and everything that comes with Instagram, right? Which inside, Facebook and inside Instagram, you have so many various things in there, like the Facebook Marketplace and shopping and all those sorts of things, right? In Facebook groups and inside Instagram, you have so many various things like Reels and obviously the traditional Instagram side of the business, Instagram shopping, IGTV. You obviously get WhatsApp when you buy Facebook, where they own the WhatsApp company. You get Oculus, and Facebook's in the number 1 position to be the biggest player in metaverse, okay? So price to sales ratio of under 5 on the stock right now, PE ratio of 16, which is just silly low. It's just, I can't laugh without saying it. And price to book of about 4.6 on the stock. So Meta, I absolutely love this one. Balance sheet's incredible for this company. And when it comes to Meta, they're almost all the big techs are in this tough year-over-year comp situation, and they are the same type of situation essentially. Okay, now EPS is expected to reaccelerate next year, so Meta, this is kind of like a down year for them. Now, as far as current year, 8.5% revenue growth expected, 16.7% growth expected next year, so a reacceleration. Now you can say, well, why not buy this stock in 2023? Okay. Because, and that's, you can say that about all these big tech companies, like things are kind of bad for them in 2022. Why not wait till 2023 to buy a lot of these stocks, right? Well, the thing is Wall Street's a little smarter than that, okay? So if your business is expected to get better in 2023, then what Wall Street will likely start doing is loading up on these stocks outside of a massive, colossal, like Great Recession or something like that, like a financial crisis, okay? So let's put that to the side. So outside of that freakish scenario, then Wall Street will start accumulating these stocks heavily, obviously in the back half of this year. And the reason being is if they understand 2023 is going to be an exciting year for these companies and re-accelerating of growth, beating numbers, things like that. They're a little smarter than that, so they're going to get out ahead of that, right? So it's always my job when it comes to these stocks is to beat them to their punch, essentially, okay? And so I understand that when it comes to Wall Street, they're going to look very, very heavily at these in the back half of this year. I got to be in before these, and so that's why I'm relentlessly kind of adding a lot of these stocks now. I'm trying to beat them to the punch there, okay? And so yeah, Meta is one of those stocks. Next up here out of these stocks, number 4 of 10 is the Planet. So Planet. So Planet, they obviously own massive, I call them Disneyland of cannabis, essentially. And the company's incredible at, the way they do their stores. They also own a bunch of brands that are very, very successful, and they're taking market share when it comes to their brands. $360 million market cap, roughly. Price to sales ratio of about 3 on this one. Forward price to sales ratio, much under that. Stock's been hammered, 45% down year to date, and at about a 1.9 price to book ratio when it comes to the Planet. Now, when it comes to Planet, this is a company that's expected in 2022 to have 50% plus revenue growth. We'll see what happens. They got several stores they're supposed to open at some point this year. We don't know exactly what quarter they're going to open, what month they're going to open. That's going to shake around numbers. So, and also we're going to get to see how the Orange County store ramps up. This will be the second summer the Orange County store is open. So I'm very, very, very excited to see what transpires there with the Orange County store and what the numbers come in at there. Obviously, Vegas should be crazy this summer. And I think that bodes well for the summer numbers, in my opinion, at least for the Planet, okay? So that was one I'm relentlessly buying. It's $1 something a share. It's, for me, I think it's kind of stealing money, and it's my favorite play in this space, okay? Next one up here, number 5 of 10. Hey, everybody knew this one was going to be on here. Obviously, I'm relentlessly buying the Chef. This stock's been, like many stocks, just hammered this year. It's down about 47% year to date when it comes to the Chef. And this is a company that basically they're expected to make massive progress on the bottom line when it comes to their EPS, their net loss, expected to shrink massively in 2022. And then next year, they're expected to lose money, but a very slight amount of money. In my personal opinion, they're going to actually have some profitable quarters in 2023. That's my personal opinion. They'll have at least 1 to 2 profitable quarters in 2023. And I think that's going to be massive for this company and for the stock price, because a lot of people want to see this company get to profitability. And as they make more and more progress to getting that, it's going to be a great thing for the psychology of this stock, right? And people's trust for the stock. So when it comes to the Chef, there's massive category growth. Like plant-based food is just getting bigger and bigger and bigger, and like we're not going backwards on that. It's just continuing to move forward year after year after year. It's a brand expansion play, so no one ever heard of this brand 2 years ago, and it's already becoming a pretty big name in the plant-based food movement. They have store expansion going on. The amount of stores they've gotten in the past 12 months is ridiculous. It's way better than I ever anticipated. They have SKU expansion. They keep the pedal to the metal when it comes to how many different SKUs they're getting out there. Margin expansion is going to be a huge thing for this company in 2022, 2023. I think basically every year moving forward, they're going to make margin expansion essentially. So I think their margins in 22 will be better than 21. I think in 23, they'll be better than 22. 24, they'll be better than 23. I think year in and year out, the margins will get better and better and better. They started their business in the worst margin situation, and moving forward is just going to get better and better, in my opinion. Now, as far as revenue growth goes for this company, over 30% expected this year. 23, they have 24% as far as analysts have. We'll see how all that shakes out. A lot of that's going to depend upon, not just sell through and velocity of product, but a lot of that will also come down to new SKUs and new products outside of the frozen aisle that the Chef is launching, and how successful or not successful those products are. So that's a complete wild card right now. I wouldn't even, if I was Wall Street, I wouldn't even put numbers out there right now, because that's, I think we'll get a lot more clarity about that in 4Q of 2022, okay? So that's one I'm buying heavily right now. Number 6 of 10, PayPal, PYPL. Never owned this stock till very recently. I mean, the stock's been just hammered. Stock's down 52+% year to date, it's just been level. If you don't know PayPal, they own PayPal and they also own Venmo. And when it comes to PayPal and Venmo, those are usually the top 3 most popular finance-related apps in the United States of America and many other developed markets out there. So huge player in that. Market cap right now is around $100 billion. Recently, this one was under $100 billion, which is crazy to think about, right? Price to sales ratio of 4, which is once again just laughable for companies that are in this category with this sort of growth. PE ratio under 30 on the stock. Price to book of around 5 when it comes to PayPal. And this is a similar story like many big techs where they're taking a step back this year when it comes to EPS, and then they're expected to reaccelerate in 2023, all right? Up to $5 on a record number there. 22, 12.4% revenue growth is expected. 23, 17% revenue growth expected. So, yeah, obviously, I just see PayPal as just continuing to be a growth company. The valuation is very attractive. A PE of under 30 on the stock, in my personal opinion, is way too low. Way too low. So that's why I'm buying shares of this one. And this is going to be a year I just continue to accumulate shares of this one. Number 7 of these 10 stocks, the Honest Company, HNST, that basically makeup, diapers, wipes, soaps, shampoos, those sorts of products is Honest. So very much a needs-based company that resonates with the millennial generation and the future generations much better than I think traditional companies, and that's why they continue to take market share. Market cap of under $400 million on this company is just laughable. Price to sales ratio 1, a forward price to sales ratio of, in my opinion, based upon what I think they're going to do, is probably under 1 right now. Now, when it comes to Honest, the stock price has been devastated year to date. The stock's down about 47% on this one. Price to book of about 2 when it comes to Honest. So companies expect to make massive progress this year when it comes to EPS. And then next year, it's interesting. 23, they had the company losing 16 cents. I think the company's going to be right around break even or maybe even have positive EPS in 23. I think a lot of the cost problems for Honest are going to alleviate massively. And I think this company's going to be in a very strong position. And I think they're going to be able to raise price in the categories they compete in. And ultimately, I think with scale that they're getting to and distribution, I think they're going to ultimately either take a very, very small loss or actually be profitable in 23, which is going to, in my opinion, shock anybody that really keeps track of the stock. Okay. Now, analysts also don't have the company growing in 22. I think they will grow in 22. I want to be very clear about that. I don't expect strong growth. And the reason being, by the way, is basically their sanitizer business was tearing it up in Q4 of 2020 and into Q1 of 2021. Their sanitizer business was amazing. Obviously, not everybody's out there buying sanitizer like crazy, so that hurt their numbers short term. But I still expect this company to grow their revenue by the end of the year in 2022. Next year, growth is expected to get back to strong growth again, 9% plus. I expect this company to grow anywhere from about 6 to 12% a year for literally like this entire decade, essentially. Like this entire decade, I expect the company to grow 6 to 12% year in and year out. Quarters can be messy. Sometimes it comes in way better than expected, sometimes with less good than expected, okay? Number 8 of these 10 stocks is Corsair Gaming, CRSR. Corsair Gaming is a $1.5 billion market cap, a price to sales ratio of under 1 now in this company, of 0.8 when it comes to Corsair Gaming. Stock has been hit, but it actually for how many, for this sort of market we've been in this year, 26% actually isn't that bad. Corsair has been holding up pretty decent. I think one of the main reasons is Corsair's a low valuation name and a really strong profit company. PE ratio of 16 on the stock, price to book of 2.7 on this company. If you go ahead and you take a look at EPS, 143 in 22. Expected here, and then a reacceleration of 176 with GPU pricing starting to come down. That's big. That's big for Corsair Gaming. If we can get a big game or two launched, that would be huge for Corsair Gaming as well. But nonetheless, as this year transpires, the comps get easier and easier. So if you look at the March quarter, the analysts expect the company revenue to be down about 23%. But then you look and the comps just get so much easier year over year. And so Corsair is just going to be in a better and better spot as the year transpires, essentially. Only 1.5% revenue growth expected in 22, but back to normal-ish growth for this company in 23 of 14.5% is expected by analysts. 9 analysts cover the stock. Personally, I expect Corsair to grow anywhere between about 8% and 15% a year for basically this entire decade after this year. Like I said, they had their one kind of freakish, numbers are just helped. I mean, you put everybody at home and everybody's going to build gaming PCs like left and right if you force everybody to be home and you can't do anything out there, right? But all that's going to alleviate as this year transpires on. So I really like Corsair Gaming long term. Good management team at that company as well. Avant Brands, really small market cap. And obviously compared to a lot of these other companies, extremely small market cap. But at the end of the day, I care about making money. Like, as Ray Shremmerd said back in the day, I ain't got no type, okay? And when it comes to me and stocks, I ain't got no type. If I make money, I don't care if it's a $36 million market cap or a $36 billion market cap or there aren't any $36 trillion market caps out there. But when it comes to Avant Brands, $36 million market cap's teeny, right? Price of sales of about 3 on this company. Price to book of under 1 when it comes to Avant Brands. Norton's been leading this company and doing a phenomenal job running the business. Stock's down about 33% year to date. It's been kind of hammered, but their numbers are extraordinary. This is their last quarter. It blew me out of the water. No one pays attention on Avant Brands other than Avant Brands shareholders, so no one even looked at this. But basically, the company had record gross revenues of $4.6 million. That was 107% growth year over year. In a market where countless companies are having trouble making numbers, right? This company growing over 100% year over year is insane. 67% on a quarter over quarter basis. Like, that's just ridiculous. They increased recreational sales by 25%. They achieved positive adjusted EBITDA. They achieved positive cash flow from operations. They also maintained a strong capital position with almost $12 million of cash and no debt. So when I look at this company, yeah, man, I absolutely love it. And so the stock recently has been trading anywhere between like 17 and 20 cents a share. I'm just looking to add more and more shares. I don't know. I think I might even own over 1 million shares of this one. And who knows, maybe I'll own even more than that in the future. So definitely like Avant Brands. Now for these last 3 stocks here, what I did is I plugged in 3 stocks that are definitely the possibilities of what I would call strong buys for me for 2022. Now, these ones I don't have positions in as of right now, but I'm very much considering positions in these 3. And I would love to hear from you guys if you have a preference of any of these 3 stocks from you. These are 3 I'm definitely going to consider down here, okay? The first one up is Palantir, which is kind of at the cross sections of artificial intelligence and data and helping companies and governments use that data to make better decisions, right? And so Palantir has just been kind of in a bad place. Stock's down 43% year to date. It's trading in the 10s right now as far as Palantir goes. $21 billion market cap, about a 14 price to sales ratio, but you got to understand companies like this trade at much richer price to sales ratios than usual, and a price to book of about 10 when it comes to Palantir. So I'm strongly considering that one. Next one I'm strongly considering actually, and I never thought I would see the day when I would actually be considering buying Netflix stock. But this stock has fallen so dang much now that I'm like, I might make a move here, okay? Year to date, the stock is down 66%. It's an $88 billion market cap, 2.9 price to sales ratio on this one, a PE ratio of 18 on Netflix now, and a price to book of about 5 for Netflix. So yeah, I'm definitely strongly considering actually buying Netflix, man. I never thought I would ever say that on this channel, but your stock price comes down a lot, enough. I'll consider almost buying anything, okay? Shopify is the next one up here. Stock price is down almost 62% year to date. Everybody knows Shopify, massive e-commerce player. They've done an amazing job building this company over the past 7 or 8 years specifically. A market cap of now $58 billion. This is one of the few companies that I always look at and I'm like, I could see this being a $1 trillion company long term, right? Price to sales ratio about 12.7 on this company. P ratio about 20, but don't really look at that. They had a one-time kind of adjustment there that made things look way better than expected. Price to book of about 5. So yeah, I mean, those are 3 stocks I'm strongly considering adding heavily. Palantir, Netflix, and Shopify. But let me know if you guys got an opinion on any of those 3 stocks. I'd love to hear from you as always. Also, check out FTX. First link in the description down there. Easiest way to buy crypto. 85% lower fees than competitors. And make sure you use my referral code, Holy Smoke, guys. Much love as always, guys. Hope you enjoy this and have a great day.